we want to finish up this discussion on papers 3 and 4. And then I want to do a quick discussion on portfolio managers. It's one of my favorite topics. I know they haven't been teaching that class ever since Misra retired. You kind of missed out not being able to take portfolio management with Misra. I'd love to teach that class, but I'm kind of filled up with classes, but I'll talk really high level. We do a little bit more, much more of that in my risk management class. So we'll see how far we can get. So just real quickly, Oliver, Carlos, Edgar, Tony, Garrett, Hunter, Adriana, Adrian, Alex, Taylor, Olivia. Oh, where's everybody? Giselle, Ashley, Alvaro, Eric, Laura, Tiana. Okay, man alive. Whoops. All right. So last week we got our discount rate. I used the forward curve, or whatever you're going to use. Remember, you've got to somehow come up with that. The market risk premium using the implied approach. You'll probably put this chart in your paper somewhere to support your assumptions. I love this chart because you can just see, an 8% or 2% assumption is just way too high, way too low. And so I think this gives you a good ballpark. Not that you wouldn't completely disagree with this. I was reading an article in Young Finance Today saying all these people quitting their jobs as firms are reacting to that by technology. Well, that's a permanent change. If you replace workers with robots and then the workers want to come back, it's like, sorry, we've got robots and they don't strike, they don't ask for raises. So there are things going on here. So we got our expected return on stocks of 7.8%. So our market risk premium, I thought we already did the market risk premium, but I don't see it. So what is our market risk premium? So market risk premium is just me expected return on stocks minus our risk-free rate. So the next thing we need is beta. So you've got to do the 4-step process. You got to do it on the paper. You got to do it on the exams. So just get used to it. The first thing we're going to ask is Walmart, revenue sensitivity. I'm going to say this is clearly a defensive company. They sell their discount store and their history supports it. Two of their best years are 2008 and 2020. So this is a firm, not only do we just logically think that they're low beta, we can see it at the two most crucial points when we had market crisis. They did great. They're one of the few stocks that did well in 2008. They did extremely well in 2020, not so much because of defensive, but mainly because of just the nature of that particular crisis. So what else can you do there where you just have a good enough discussion to explain why you think that company's defensive or cyclical? Some companies, it's pretty obvious. Grocery stores are obviously defensive. Heavy manufacturing is obviously cyclical. I thought I was sharing the screen, but I'll do it again. I may just hit the wrong button. So, have some discussion there. The key is, how does this firm perform? I usually think recessions. I mean, it's both recessions and growth, but I usually think recessions. How this firm perform in recessions is not, do they perform well in recessions? The goal is all relative. Versus the typical average company, is this firm going to do better than average or worse than average? So they may all do horribly in a recession, but if they do less bad than everybody else, that still makes them a lower beta company. So remember, beta is always a relative thing, relative to everybody else, not absolute kind of thing. The second thing is operating leverage. I heard a really good, I don't know if y'all been listening to that business breakdown podcasts. Yesterday they did, I listened to HelloFresh. I don't know if y'all used that business before. I just thought that was a horrible business because Blue Apron's done so horribly. I don't know what HelloFresh was, but he was talking about operating leverage. It's a really interesting discussion. But boy, at one point, I think I'm actually going to play some of this for my executive BA class. I like that podcast especially when they have founders or CEOs of the company talking, and they had the founder of the company talking, and they're just so much more interesting. They had the former CEO of Cinnabon, and boy, very interesting. She definitely knew her business. She talked finance, so she definitely has a strong finance. The founder of HelloFresh, I don't know his background, but boy, he definitely knew his business. He understood finance. So, I'm thinking about this business just to show you how I think about a business. So what does the HelloFresh do? Y'all have used their products before, anybody?
Yeah.
Meal kits, anybody ever used them before? Is it pretty good food?
Yeah.
Right, it's okay, yeah.
It's like,
Yeah.
depending on how good of a cook you are.
Right.
Yes.
So when I think about a business, he said his raw materials, so he's got revenue of $1. And he says his raw materials were 35 cents. All right, so I think about that and say, okay, so, always think about the customer. What does the customer have as a choice? There's grocery, right? You always have that choice. In grocery, I'm going to include in that CPG. I don't know what CPG is. You remember what that is from your consumer packaged goods? All right. You got restaurants. And now what do we have? We have DoorDash. We have curbside. So the consumer has a lot of options today. I hear that 35 cents raw material, and the first thing I think is, well, that means the consumer is going to spend 3 times more if they go to this firm versus they go to grocery store. But then he explained that's not true. Because first of all, they're buying, he said, 300 items, where a grocery store is buying 50,000. So he's got some buying power. So the items he's buying, he can get a really good deal on. Secondly, was waste, which I thought was pretty impressive. He said a grocery store, and fair, I don't know if this is correct or not, but he said produce waste for a grocery store, he said was 30%.
Market.
That's pretty horrible, isn't it? 30% when you could feed an entire continent with that. He says their waste is 1%. So right there, when you look at the markup at a grocery store, that's including that 30% waste, not on every item, but on produce. So his markup, he doesn't have that cost. So that's a huge advantage. So I don't know exactly how much more, if you buy it from grocery, you buy from a grocery store versus buying it from him, his 35 cents might actually end up costing you 70 cents. Who knows? Which is more expensive, to buy a meal from him? Did you compare price? Did you think, if I made this myself, how much would it cost?
They price it out for you and they say it's like $7 a meal, something around there, depending on which one you get.
How much do you think it would have cost if you'd gone to HEB and did it yourself?
So here's the thing is because you're only getting enough food for that specific meal, that's where it kind of saves you money, but you can't use leftover ingredients for more meals.
Right.
So you have to kind of.
Yeah, you'd have to do the math.
Like which one, like if I buy, a bag of rice, that's gonna last me, 30, 40 meals. But if I only get this one small thing of rice,
Right.
it's only lasts that 1 meal. So you kind of have to compare.
And that's what the customer is going to do, right?
But I think it's mostly a convenience thing because you're
Right,
not
right.
wasting anything.
I mean, that's the next thing is fulfillment, right? Fulfillment, I think he said that's like 25 cents or something. Or maybe that's, I forget, 15. Where am I up to? 0.25. That gets me up to 60. No, 0.35. 0.45, I don't know, I forget. But anyway, fulfillment, well, that's the convenient part, right? Because fulfillment is their time or your time. And the nice thing is they're going to measure everything else. You don't have to do all of that kind of stuff. And all you got to do is just stick it in the oven. So it saves you some time. So some of this is the customer, is the convenience. And that's worth some money, right? How much is the customer? So it's cheaper probably to buy it yourself from HEB, but you get some fulfillment. And then the last thing he said was his operating leverage. And that was marketing and G&A. And he said his EBITDA margin was 10%. So if I did the math right, this is like, I don't know, 15 cents and 2 cents. Does that come out right? Dollar minus 35 minus 45 minus 15 minus 5 minus 5. I was probably right the first time. Come on, Bill Gates, you can do it. I know you can. So it's probably right the first time. So that's what he said his numbers are. What is his operating leverage? Well, these are fixed costs, but then the other thing he talked about was with marketing. This is really key when looking at a firm. There's two marketing. There is the new customer and there's retention, which is easier for a firm like this to retain customers or get new customers. New customers is really expensive. Have you seen what DoorDash is doing? I saw one article. Someone figured out that a restaurant could have actually purchased their own food from DoorDash and gotten DoorDash's reimbursement. They would have made money. So DoorDash is actually selling the food for less than what the restaurant got reimbursed from DoorDash. Why were they doing that? Because they're trying to get people signed up. That's a lot more expensive than retention. What is retention? Retention is you better produce really good food and deliver it on time without error, right? That's retention. He's got to get that, but that's a lot easier. So that marketing part is part of the operating leverage. As they get the more markets, more of that marketing is just going to disappear because it's new customers. And so, and then the G&A, that's somewhat fixed. So he's talking about, we've got some operating leverage. He doesn't have much operating leverage, right? Only 20 cents. The rest of this, you know, what happens to fulfillment if his sales go up 20%? He's got to hire 20% more people, right? Unless he just becomes more productive with that manufacturing. And so I'm thinking about from the customer standpoint, they can probably do it cheaper from a restaurant. I would sit down and actually do the numbers. How much cheaper is it for them going to HEB and do themselves? How much time is he saving? I would go through all of that because the customer is going to figure that out. And then the quality of food is really important. So if I were thinking about investing in HelloFresh, I would probably order some of their meals just to see what it's like. He said the average customer, I don't know about this, but he says when we eat at home, the average customer has 7 meals. So that made me go through in my mind. There's 12 that I do, so I can't imagine I'm greater than the average person, but somehow I guess I am. I don't know how that is, but so somehow I got 12 meals. I tend to rotate all the time, but 7, there's 7 days in a week. So I guess most people are like, you know, it's meatloaf Monday or whatever. And they're doing what, about 50 meals, 30 to 40, 50 meals. So there's more variety. So I do that. Will this model actually work? And then he got the question in the call was, why are you so successful and why did Blue Apron fail? And he refused to answer that question very craftily. But I like what he said. He said, first of all, this is a complex, y'all agree this is a complex business? He's got sourcing, right? He's got to get his raw materials. He's got to get employees. He's got employees in 25 different sites. He needs them all to do the same thing, which is practically impossible. He's got distribution. He's got a delivery, right? Delivery is pretty complicated. Does he do his own delivery or does he hire the people? They want to do their own delivery and it needs to be same day. So, you know, it's a complex business. And he said, which I really loved, he said, you be successful by being world champ athlete in every single one of those things. That's what we talk about, the value chain. He was a very value chain person. So we got procurement, we got fulfillment, we got marketing, we got distribution. We've got to be world-class in every single, we can't have a weak link anywhere. And what he talked about with, I don't know anything about Blue Apron. He said Blue Apron was kind of like a world-class athlete that just pulled a muscle. So a sprinter, the greatest, one of my favorite athletes, who's the Jamaican, Bolt. Yeah, man, just incredible how fast that guy is. But how would he do in World Champions if he had pulled a muscle? Be terrible, right? And that's essentially what he said. In a business like this, you can have no weaknesses. And so this kind of firm I would want to work for. That's the kind, if you're looking for a place, go interview with this company. If I were trying to find a nice, good place to work, a CEO knows what he's talking about, understands the business, and he's focused on the right kind of things. I said, Mud, I would love to work for this boss. But I, as an investor, I'm going to go to the customer side and see, is it really value to the customer? Obviously, COVID was a great thing for them. Can you imagine? This is like, wow, this is wonderful. How much of that will continue? We said, well, we got a whole bunch of new customers that were doing 5 meals a week. Now they're going to switch to 2 meals a week. That's still great for us. We're not going to lose that. They're not going to leave us. And he also talked about the difference between his business and SaaS. If y'all have heard of SaaS, I remember what SaaS stands for. Software as a service. When SaaS loses a customer, they usually lose them forever. When he loses a customer, they usually leave for 3 months and then they come back. And so it's a very different model. I'm not sure it's a great scalable model because these two things are you can keep growing as the business grows. So he's not working with much margin there. More margin in a grocery store, no question. And it sounds like grocery stores, if they could figure out how to reduce that waste, they could do some really good stuff there. But it's tough with produce, right? Boy, I buy the greenest bananas I can find, and after 3 or 4 days, they're already turning dark, and all this. It's hard. Produce just doesn't last that long. The thing I thought was the most interesting to me was delivery. That sounds like a really complicated part of this business. And how do they keep that going, especially with the work? How do you find workers to do that? What do you pay them? How do you incentivize them? So do you really want to keep that cheap? What's the one part of his business that actually sees the customer face to face? Delivery. Do you want those to be decent people? What is DoorDash like when they come to your door? Is it a pleasant experience?
They just kind of leave it there.
Just leave, they ring the door like FedEx?
Yeah.
I think FedEx is like already in the starting blocks when we ring the bell, and it's like, we got to be driving off when they come out the door. So this is a complex business, but boy, do they have a good CEO. I love listening to CEOs of companies. I'm tempted to invest in a company like that just because the CEO is talking the way a finance person wants them to talk. That's really, really impressive. So anyway, but he talked about operating leverage, but he doesn't have much operating leverage. He said, well, these two costs are not really going to grow as the business grows. So that's 15 cents. That is, the dollar goes to $2, that 15 cents becomes 7 or 8 cents. As we go to $3, that becomes, it just keeps shrinking because we don't need to build that piece. And then especially part of this 15 cents will actually come down because as they get it to more markets, they don't have to get that new customer marketing, which is where they actually lose money. They can do the retention. And then from the customer standpoint, is it worth it to the customers? So I would ask, how much more is that $7 meal versus what they could produce? What's the quality? What's the convenience? How much time they're actually saving? I was kind of surprised he says it takes 30 minutes to prepare his meal. I guess you just stick it in the oven, right, and turn it on.
No, you
have to mix it, right?
Instructions, something like that.
Yeah.
So you still cook the food, it's just all raw ingredients. And then
Yes. So it's measurement he's helping you with, right? And stuff like that. So he's helping you reduce your waste as well, right? So you don't have that waste. I remember I took a cooking class, and the first thing they taught us, which is such a waste, they taught us how to clean a chicken. It's like, I'm never going to buy a chicken. And they say, oh, it's so much cheaper to buy the chicken than to buy the chicken breast, or whatever. It's like, yeah, but if I buy a whole chicken, I'm going to throw 90% of it away. I mean, it's like, so it was a wasted class. So there are advantages to things like this because, you don't necessarily want to buy all these ingredients that, you might use over the next 7 years kind of thing. So anyway, so the operating leverage, we're talking about the fixed costs of the company. Well, obviously with a Walmart, a lot of hourly workers. As business go up, they can hire more workers. As business declines, they can hire fewer workers. They have workers that can do stuff while they're not so busy like inventory or stocking and those kind of things. Now they have the curbside delivery, which allows them a little bit more flexibility with the workers. So I think on the labor side, I think the labor is generally floating variable costs. Generally, they don't have they do have managers and others that are fixed costs, but I don't know at a Walmart if the managers at Walmart are probably a lot of them are hourly workers. So I don't know what percentage of Walmart's workers are hourly versus salaried, but I bet it's a pretty high percentage. They also have, their cost of goods sold is extremely variable, right? Walmart's not going to buy coffee. Coffee goes up 20%. They're not going to buy coffee and resell it and make a loss. Coffee prices go up. What are they going to do? They're going to increase the price of coffee. That's pretty obvious. So they have a fairly stable gross margin, no question. They're going to charge, and people know banana prices go up. They know they're going to pay more for bananas. They're not going to blame Walmart for that. Obviously, if Walmart increases their banana prices 30%, but HEB doesn't, you're going to have to ask, okay, is HEB buying their bananas from someone else? Is HEB taking a loss? That doesn't make a lot of sense. When you have such a thin margin, you have no choice but increase your prices. So I think it's a fairly volatile, variable, variable cost thing. And there are products definitely like milk and others that the margin may be zero, even slightly negative. There are loss leaders just to get people in the store and then hope they buy the higher margin items. But they're not going to take a huge lot. They don't have the ability to take huge losses on these things. So I gave you a file that shows you how to do this. Hopefully I saved it, so I don't have to go load it. But looks like I didn't. So let me go load the file. I can at least show you where it is. So if you go into our contents and files for papers or paper descriptions, you have, did I not load it? My word. Okay, let me go find it. I can't believe I haven't loaded that. Yeah, that makes so sense. Hopefully I'll remember to load it today. I think I have it in another class. Okay. No, that's not it. Sorry. All right, I'll load this to our file. I can't believe after all this time I'm still forgetting. All right, so this file here. So what I recommend you do before you click here is go to the page value page and find your company. Usually you can type your ticker, space, and the letter U, and that should get you there. So there's Walmart right there. Here's their gross margins, fairly stable gross margins. They're coming up a little bit, but they've been pretty stable the last few years, right? 25, 25, 25, 25, 26, 25, 25. And here's their net margin, 6, 6, 6, 6, 6, 6, 6, 6, 6, 6, 6, 6, 6. Uh-oh, 5, 5, 4, 4. So they've been declining the last few years, probably because of Walmart, but still very, very stable. And still higher than Costco. So I'm going to click on there, and then so here when I just do equal and go to this page, I'm already there. And that brings up all my data. I'm going to take this. See if I can paste it a different way. Yeah, it won't let me. Vaughn showed me how to do the snipping tool, but I can't remember how to what the function was.
That's what this try.
But he said there's a button you can push that just brings it up automatically, and I just forgot how to do that. So, all right. All right, so let's look at the gross margin. Their gross margin, remember on the paper, don't say their gross margin is 1.12%. That's not right. That's the standard deviation of their gross margin is 1.21%. The standard deviation of the market is 3.51. So they're one of the most stable out there, and that's what you would expect with the retail on the gross margin. More importantly is their net margin. Net margin standard deviation is actually more stable than their gross margin. It's only 0.51%. Really, really stable margins. The typical stock is much higher. You would expect it to be higher. Look at the 90th percentile, 135%. There's some really, really volatile firms out there, but they're one of the more stable firms out there. And so what I'm going to say here is the standard deviation of their gross and net margins support this thesis of high variable, low fixed cost for Walmart. What does that suggest for the beta? Well below 1, right? Because that first one already said well below 1. So this first one is beta well below 1. The second one is beta well below 1, and the standard deviation of their gross and net margin supports that idea. Now you're going to find some firms, especially on firms that you are expecting volatile net margins, and then you actually pull up the chart and you find out their net margins are actually pretty stable. I see that a lot. So how do you handle that? You'll just have to try to figure out in your paper how you address that. A lot of students, what they'll say is, I was expecting this number to be high. It is actually low. However, I'm going to stick with my original proposition. This firm has a lot of operating leverage. They have a lot of property, plant, and equipment. So they have a lot of depreciation expense. They've got a lot of salaried employees. They've got a unionized labor. All that suggests they have high fixed costs. Somehow they're managing their net margins in a way that they're not that volatile, but I'm still going to say this firm has high operating leverage. And then the easy one, which is financial leverage. There you just look on the chart and how do they do there? Their debt to equity. This is their debt to equity. It's not the standard deviation of their debt to equity. Their debt to equity is 72%. The stock market average is 60%. So their debt's slightly above average. So slightly above average debt to equity, but not materially so. Little impact on beta. So there you have to decide, obviously, on your firm whether they have a lot of, if they have a lot of debt, you're going to push up the beta. So here's the key. Number one, revenue sensitivity is the most important. Is your firm below beta, below 1, well below 1, around 1, above 1, well above 1? Once you decide that, that's going to stick through the other ones. What the other ones are going to do are move it further away or closer to 1. So if you got a firm like Kroger that's obviously well below 1, but with a lot of debt, you're not going to push them up to 1.4. You might push them from 0.5 to 0.6. All right. You're not going to go crazy with the numbers. So operating leverage and financial leverage, if they're low, then it will push it, you know, if they're like a 1.5 and they have low leverage, then you might push them down to 1.4 or 1.3. All right. So you don't go radical on those numbers. I haven't seen too many firms that operating financial leverage pushes them from 0.5 to 1.4, unless you just got a really crazy, heavy debt firm. And even Kroger's is kind of in that category, and I don't think they fit there. All right. So that's how you do that. So these charts will probably be, this chart will be in your paper. Anybody remember what's the fourth thing? Your history. So I'm going to cheat on this one. Maybe I can give you all this file as well. It's the one I accidentally loaded. So I've already got the S&P 500. I will, if I remember. I keep forgetting to put these out there, but I do have the S&P already loaded. So all I got to do is go out there and bring in Walmart, not Waste Management, and go get historical data. I'm just going to go back to the max. Historical prices monthly, apply, download, just like that. I've got Walmart's prices. We're going to use the adjusted close. So I'm going to take that. I'm going to bring the S&P over next to it. And make sure the dates are lined up. Looks pretty good on the dates, doesn't it? I'll go through October. So I got January through October, everything's lined up, so I can get rid of the dates there. There's Walmart. So then we need the holding period. Oops, sorry. The holding period return. Sorry. So we got Walmart, I got S&P. So holding period return, take ending market value minus beginning market value divided by beginning market value. Why don't I have income in there? Yes, adjusted close, the income's already in there. And somehow magically Walmart had exactly a 0% return in the first month, but there's the holding period returns. And then we're going to do the rolling beta. We want to do 5 years, so monthly. So we need to go down 60 lines. There's 60 right there. So, and then we'll do equal slope. Have to start with Walmart. You can't start with HEB. I mean, you can't start with S&P. Excuse me. That's the one downside of the doing that versus the market. I think I've already done this in the class before. So then I'm also going to do the percentile. Well, let me copy this down first. There's their betas. Now I'm going to do the percentile, but one thing I'm definitely going to notice with Walmart is you got two companies going on here. You might find this with your firm as well. There's the Walmart as a small company, Walmart as a big company. So there's a big shift right here at 0.213. And so I'm actually going to, for my company, I'm going to go find that 213 and see where it is. So I'm going to start 2006. It's going to be my point. So when I do the percentile, I'm actually going to do it. Where did I put that? There it is. I'm going to actually do it from 2006. So I'm going to take the percentile. So the 90th percentile in attempts from that date. And you can tell me if it makes the chart make more sense. So now when I graph it, my ranges is with Walmart as a big company, right? Not Walmart as a small company. You can kind of see it. It'd make a big difference if I do that. So then I got Walmart rolling beta, 5 years. Obviously, you got to put some dates in here. And on the dates, all right, thanks. It's hard to talk and do this at the same time, but so find the dates. And on the dates, you don't need months or days, so you can format it. You just need years, so just make it year. You got it. Got it. All right. There's at least 20% of students that don't do this, and that just took me, what, 10 minutes? What college student says, you know, I'll give up 10% of the paper grade because I don't have 10 minutes. I don't understand that, all right? And this is me doing it, and you guys are much faster in Excel than I am because you're college students, right? You're young people. So I have students tell me, wow, you're fast in Excel. And it's like, if you think I'm fast in Excel, you're way too slow in Excel. You got to bring up the game because Excel, you guys be 50 times faster than I am in Excel. So it only takes a few minutes, right? I did that really, really fast. It's really easy to do. The data's all there. It's all out in the internet. So Walmart's history suggests a very low beta, below 0.5. All right, one thing you can do to really help yourself at the end of this is when you're doing the beta determination is have those things up there, revenue sensitivity, operating leverage, financial leverage, history, and just talk on each one. So revenue sensitivity suggests 0.4 to 0.7, and you have some comment definitely a defensive company. Operating leverage, high variable costs, low fixed costs given labor structure, and borne out by low volatility margin, something like that. Financial, so range 0.3 to 0.6, so that's going to bring it down some. Financial leverage, slightly above average, but not materially so. And in history, 0.1 to 0.5, very low betas last several years, something like that. If you do this, then you don't lose points for what a lot of students lose point on. If they do all of this and then their final recommendation is all based on histories, like they completely ignore everything else they talked about. So here, I'm going to say my final beta, I'm going to go with 0.45 with a range of 0.3, 0.6. So 0.5 is going to be my base case. That's somewhat consistent with what I have there. And I don't want a range between 0.3 and 0.6. I could even go higher, maybe even 0.7 on the range. But I've got my beta. All right. So you got to support your beta. And once you do that, you just have one last thing to do. So your Walmart discount rate, you got the risk-free rate, market risk premium, and beta. So our risk-free rate was 236. Our market risk premium, I should have highlighted that, is 544. And our beta is 0.45, could be as low as 0.3 or as high as 0.7. So discount rate is the risk-free rate plus the market risk premium times beta. Get some really, really low discount rates. I'm actually quite uncomfortable with these discount rates for Walmart. The 3.99, especially because you can buy high yield bonds yielding more than that. Is Walmart a safer investment than high yield bonds? I guess you could debate that one way or the other, but so there's your paper 3. That's the last thing on your paper 3. This has to be in your paper 3. You might want to go ahead and set that up in paper 3 because I want you to use those in paper 4 to get some ranges. But that's it. That's paper 3. So a lot of times in finance classes, we give you this number and give you this number and give you this number and ask for this number. I don't want to do that because in reality, your boss gives you none of these numbers and you got to do exactly what we're doing in paper 3. So you got to get in the habit. You've got to come up with the numbers. Bosses don't give you inputs. You've got to come up with your own inputs. That's what they're hiring you for. And you got to be able to explain it. So that's what paper 3 is I'm going to use a 236 risk-free rate. Why? The 10-year treasury is only at 1.6%. Why are you using 236? Well, I just think it's unusually low and a lot of noise because of COVID and the Fed and all this concerns. I want to use a forward curve so I get out of this noise. So you can logically talk yourself through all of these assumptions and be rational about it. If you can do that, you're ahead of the game for most of your competition. So, all right. Questions on paper 3? You'll handle that. I'll show you an example paper here, maybe next class or so. All right, so now we get into paper 4. Well, paper 4, what do we need? We need dividend 0. All right, we talked about this stuff up above. What stuff do we need? So dividend 0, we need EPS 0. So these two things we can just go look up in Yahoo Finance. Pretty simple. On the historical data, to get the dividend, instead of doing historical prices, just do dividends. And the historical dividend is the last year. So for Walmart, it's pretty straightforward. For some firms, it may not be. They may only pay dividends once a year or twice a year. Sometimes it gets real tricky. If you want to do Costco, Costco is really bizarre. They pay small dividends, and then massive dividends, and then small dividends. How would you handle that? That's going to be a little tricky. Do you take an average over the last 5 years or something like that? They even show you, just so you can see it. So 79 cents, 79 cents, 79 cents, 70 cents, $10. 70, 70, 70, 65, 65, 57, 57, $7, $5. And it's not like every other year, every third year. Sometimes it's every third year, sometimes it's every 4 years. That's a tough one. The theory says what? Use the last year. But would that make sense if we were sitting right here? Would your valuation change a little bit? All right, so you can't ignore stuff like that. Well, Costco is doing something bizarre. Who knows why they do it like that? That's not the norm. Most companies are like Walmart. Walmart was a piece of cake, wasn't it? It might work. 55, 55, 55, 54, 54, 53, 52, 51, 50, 49. Anybody want to guess what their next dividend is going to be? I'm going to guess 55, then 56, 56, 56, 56, and then 57, right? Very predictable. There's a theoretical problem with that too, but you can go with it. So theirs has been very predictable. So their dividend is just 0.55 plus 0.55 plus 0.55 plus 0.54. If your firm doesn't pay dividends, then email me, and what we'll use instead is the free cash flow per share for equity, which is like if they paid a dividend, this is about what it might be. They'll pay out their free cash flow. So that's one that you can do. The earnings per share is a little easier. There you just go to the summary page and it's right there for you. So their earnings per share is 355, and this is the last 12 months. You can't get the dividend from this page because they say it's a forward dividend, which doesn't mean anything, but you can tell what they did. They just took the last 55 cents and just multiplied by 4. But that's not what you want. You want dividend zero, which is the last year of dividends, which was 55 3 times and then 54 cents. All right, so that's what you want. All right, so their earnings per share is 355. You really want to try to find a firm that has positive earnings. They don't have positive earnings because of COVID. What you can do is normalize that and look at the earnings maybe over the last 3 or 4 years and try to get a sense what their normal earnings would have been if it hadn't been for COVID. So you can do that if you have some issues. So that's easy. That's just looking up the numbers. So what else do we need? We need growth long-term. And I'm going to tie this to economic growth paper 3. And I'm going to say Walmart will grow slower, more slowly, excuse my grammar, as they are already well saturated in their markets. So, I mean, this is a firm that's already pretty massive, already out there. You know, the way I always think about it, once they get to where they're going, they're in every market they can be. They've expanded all over the world. They've done everything they do. How fast can you grow? At that point, you're essentially limited to population growth and inflation. That's about all you can do. You know, if everybody's buying your product, that's going to buy your product, all they can do is have babies and see inflation go up. It's hard to get any more customers than that unless we have, you know, space aliens or something coming to Earth. You're going to have a tough time going much more than that. The world population is still growing and they're still expanding. There's some markets they have not done well at all, like India. So you know, you could say, but that's not going to be part of your long-term growth. The long-term growth is once they get there, they've expanded all they can. They're now just a firm that's just maintaining. How fast they're going to grow at that point? They're just going to grow with population with inflation. So what did I say economic growth was? I said 5% was for the S&P 500. So I'm going to use 4% for them. Now, yeah, I remember one of the issues I have, this 4% can't be greater than what? Am I okay with that one? It's lower than my base case, but what about my best case here? Can I use a 3.99% discount rate? I can't because it's lower. So that's going to be an issue. So I'm probably going to go up here and say, you know, my base case, my low case, my best beta case, which is my lowest beta, I'm going to use 0.35. All right. So that's the point where you might make an adjustment. This discount rate must be higher than your growth rate. That's not the case. You just can't do the valuation. Right, but you've already done that economic growth number in paper 3. Just go back and reference it. If you're doing a tech company, then maybe you go a little above that. You just think hey, these are innovative firms. They're going to keep inventing new products. So even in their normal kind of end state, they'll still be doing something that might get them a little more growth than the average company. Who knows? You have to make some argument. And then we need short-term growth. So we got the 3 approaches. So one is the PEG ratio approach. So let's go get their PE ratio. Let's go get their PEG ratio. That you can just get on the statistics page. Which PE do we want? We want the forward PE. The forward PE is, be careful on these. I've seen some, there's an error. You can just see it right there, right? I've seen this over and over again with firms. These values they're using. So one thing to be really careful at first, click on annual, all right? So make sure you have annual data. You don't have quarterly. It's not switching for me, so come on. Oh, you can't do it. Ah. Yeah, boy. Thank you, Yahoo Finance. Oh, boy, that's a huge issue. All right, so where else can you get this data if you can't get it from Yahoo Finance? I don't know why they switched that. That is a major, major, major problem. All right, you're probably okay with these two. It looks like these are okay. You can tell these numbers down here are really distorted. So you can't use them. At least these look okay to me. So we'll go with them. All right. So I think we're maybe okay. So 2242 is the PE. That sounds about right for Walmart. And then the PEG ratio is 338. Yahoo Finance has been really making some major, major changes. I think Yahoo Finance is like, hey, you're not making any money. We got a lot of people addicted to us. Let's see if they'll cough up the money. And guess what we're going to say? I'm sure not. There's other places you can get this data. So what we're going to do is we're going to find somebody else that has this exact same data. So that the implied growth there is just your PE ratio divided by your PEG ratio. And that's just 6.63%. That's just somebody's forecast. Who knows if it's any good? That's what the typical person investment.
So the worst case scenario, can we get it on Bloomberg?
You can get off the Bloomberg machine, definitely. Yeah, that's pretty easy. You just go use the FA function in Bloomberg and it's all going to be there. Yeah. All these ratios, or you can just bring them into an Excel spreadsheet. It's pretty straightforward. The second approach is the sustainable growth, which says sustainable growth equals normalized ROE times normalized retention. What I mean by normalized, well, you might want to look at a little bit of history for the firm just to see what their ROE has been doing. But I'm going to bring in the ROE. I'm going to bring in the payout ratio. I'm just going to use the current number, but here's one where you might go further back. So under statistics, you come down and you find, where here's the payout ratio right here, 61.24%. And then the return on equity is right here, 12.32%. So what is my retention? Well, if your payout's 61%, then 1 minus that is your retention. Your retention is 38%. So the implied growth here is ROE times retention. Gives us a lower number, 478. But you're not going to get the same. In fact, you can get radically different numbers doing this approach. And then the last one is just looking at history. This is, if you do this, you have to get this out of Bloomberg. But I've already done it. So here's their history. I can't remember which one is which. Series 1 is, yeah, I can't see what it is. I'll just use this one because I'm not really sure what it is. All right, that's over time. This first one is the 3-year growth rate. The last 3 years. This is the last 5. This is rolling 5 years. This is 10 years. There's 5%. I should have prettied this up much more, but you can see the last several years, they've been hovering between 0 and 3%. Not a lot of growth. I don't remember if that's earnings or if that's revenue, but historically they've had a tough time. So suggest 0 to 4% because their growth has definitely been much weaker. All right, now what do you do with all of that? Well, you can just ignore all of that. my answer. So I'll make stuff up. All right. So this is an old company, but with some new tricks. I don't know if y'all agree with that, but there is some stuff Walmart's doing that's pretty interesting. What are some of the new tricks? Well,
Walmart started to get into more commerce, compete with Amazon.
yeah, so they home delivery with a lot of stores. That's a huge advantage that they have. That may be the one reason people go to Walmart.com instead of Amazon. So Walmart, I don't remember the exact number, but something in the neighborhood of 90% of Americans live within 10 minutes of a Walmart. Can you say that about Amazon? Or Whole Food? Probably not. That's a huge advantage. That also gives an advantage on curbside. So as DoorDash and curbside and all this stuff picks up, and even more, it seems like they have an even bigger advantage on drones than Amazon does because they're just everywhere, right? They can certainly handle this, send stuff to your house kind of stuff. So it's interesting. And you've got shifting consumer behavior. I think they got a chance at this. Amazon's certainly starting to show some weaknesses, especially in their employment relations and their fulfillment. I think Amazon might be a little stretched with Amazon Prime and trying to do their own deliveries. That's an entirely different business for them. They're certainly going to have trouble getting drivers and those kind of things. And it's much more expensive, right? They're having to ship stuff a lot further than Walmart. Walmart understands the warehousing far better than Amazon, I think, in some ways. They tend to understand the turnover business. I think it's possible. So I think as they convert and get more competitive, they should have some good growth. And you can also talk about COVID. COVID has certainly given them a rediscovery by customers. It's like, okay, you were there for us, Walmart, when we needed you. We're going to be eating out less going forward. Who knows? People are talking about, someone talking on the news, we'll be wearing masks for the next 40 years. It's like, oh boy, I don't think that's going to be the case, but that we're stuck with this pandemic thing forever and ever and ever. But who knows? Are people going to change behavior? But I'm not looking for the right answer. The right answer is their exact growth in the next 50 years. So if you know that, put that in your paper. If you know that, drop out of school and go make $1 billion because nobody knows the answer to that. So I'm not looking for the right answer or I agree with the answer. I'm looking for the logic and the rational thinking behind it. All right. You might strongly disagree with this and say, Walmart, they got lucky with COVID, but they're not going to be able to compete. They're either going to get killed by the Home Depots and the specialty type of firms, and then Amazon on the other side. This is an old company. I think they're going to have to shrink the next several years. I'm going to use a -5%, and then finally they'll shrink down to where they need to be, and then they'll start growing at that for whatever you want to put down. You've got to put that down. But I'm going to give my short-term growth. Who knows? I'll give them 6%. So it can be completely ignoring what you've just done. You don't have to do the history, but you need to be learning Bloomberg, and it's pretty easy to do it in Bloomberg. So if you want to do it yourself, all you got to do in Bloomberg is put your ticker in, ask for EBITDA. I ask for EBITDA, EPS, and sales. I like to look at all of them and see how they're growing and just get some sense of how this firm is doing over time. But not required, but it's easy to do. So that gives me my short-term growth. On the ranges, I might go as low as 2% to as high as 4.5%. I'm not going to go much higher than that. I'm not gonna do a range on the short-term growth because it's not that far off from my long-term growth. And so then all I gotta do is do valuation. So I got the dividend discount model. Got the cap earnings model. Now the cap earnings model, I'm calling it the capitalized earnings model. I have students that call it the CAPM model. This is not the CAPM model. I did not create the CAPM model. I can assure you, I wasn't even born when the CAPM model was invented. So, you know, that's not mine. This is the capitalized earnings model. CAPM model is risk-free rate plus beta times market risk premium. And then the H model. So dividend discount model. Here's my KE. 3 KEs, wherever they are. And then my growth long term, I'm going to use, I think I said 4%, maybe as low as 2%, maybe as high as 4.5%. So you notice what I did here is you put your highest growth with your lowest beta and your lowest growth with your highest beta, right? Because lower beta gives you higher value, higher growth gives you higher value. And my short-term growth, I'm just going to use 6% all the way across. No variation there. And then my H. All right, so the H, this is your creative writing. So my argument was this is curbside, it's online, it's home delivery. They've got a huge advantage because of all those stores, but they got to figure this out. And the consumer's going to change taste. DoorDash is obviously having a big impact on that. Uber Eats. The world is changing. I might have in 2019 said the H of 4 or 3, but I think COVID sped everything up. And I might talk about that in the paper. COVID got people much more comfortable having stuff. I know there's probably grandmothers and grandfathers that are having DoorDash delivered that had never heard of it in January 2020. Y'all know anybody like that? Do you? I mean, there's some people, right? My generation are pretty slow. I'm completely oblivious, but every once in a while we're like, oh, you mean I can just order? Or their grandson buys them a DoorDash gift card. And then you're like, what are we gonna do with this? And they toss it in the trash, but some of them will actually, say, try to figure it out. So I'm gonna say 3. I'm gonna have to explain that. You're gonna have to explain that. I'm not gonna explain it for you here, but that's kind of my argument is I probably would have thought it would take longer. I think COVID is gonna speed this up, and I think Walmart's a pretty fast mover. They got a lot of resources. They've got a lot of smart people. I think they're gonna get some benefits here for the next 6 years. So my H is gonna be 3. All right, and they're gonna get some higher growth. And then we've got our, what else do we need? Got our dividend 0 and our EPS 0. We got everything we need all up there. There's my dividend, EPS. Dividend discount model, you got this more memorized, right? You've done this in so many classes already. Dividend 0 times 1 plus your long-term growth divided by your KE minus long-term growth. Y'all know this formula backwards and forwards, right? You've already seen it on how many times over and over again. What do we get there? Really high valuation. Really high valuation. Uh-oh. Is my growth rate? I can't do that, can I? So yeah, I'm just gonna leave that at 4. Why not do this? I'll do this at 3.5. I'll do this at 3, that at 3.75. So I'll do that. All right. Also, yeah, I got to go back and explain that earlier, but that's fine. All right, and then my capitalized earnings. We take the exact same formula, except we're going to use earnings per share Oh, where's my inflation rate? I forgot to put that in there. What did I assume for inflation? 2%. So capitalized earnings, same formula, except we use earnings per share instead of dividends, and we use inflation instead of long-term growth. The KE is the same, minus inflation. We're not going to get radically different answers there because we're just changing the beta. And then the H model, remember the H model? It's a dividend discount model, so you can just use that formula again. But what we're going to do is we're going to add that H section in there. So plus dividend 0 times the H times short-term growth minus long-term growth. You just add that section in the middle and you got it. So there's my valuation. And you can get really wide range. If you get a negative number, you did something wrong. And if you get a negative number, it's almost always because your KE is lower than your long-term growth. What else can you do where you need the current price? Some students forget to do this. Obviously, you need the current price because you're going to try to make a decision. So what is the current price? 143.17. Now, one thing I love in the papers, I'm not requiring y'all to do it, but I would recommend you learn how to do this. It's called the football field graph. Have you ever heard of that? So let me show you. We're using it in my risk management, my security analysis class. So this is a football field chart. So what you can do here, you can put the 52-week, what it's done the last 52 weeks as a range. You can put your dividend discount model as a range, your cap earnings as a range, your discounted cash flow as a range. Why I disagree with them is where they put this line. This line to me would be the current stock price. That's what I would do as a current stock price. If you don't know how to do a football field chart, guess what you do? You type football field, how to create a football field chart. There's a wonderful video. Right here.
Now it's time to start building a football.
Tornado chart. I've never heard of tornado chart. I don't know what that is. So, but anyway, you can watch this video, 5 minutes. He showed you how to do it. Why do I recommend this? Because I'm seeing it all the time. So I'd recommend, if you got some time, put this in your paper because it looks really good in the paper. Because you're starting to see this more and more and more. I like it, although I don't like having, I prefer having the current stock price as your bar. But if you don't want to do that, you can just summarize in here. So maybe your ranges, maybe you take the median of each one. And you say, okay, right now it's overpriced, right? I think it's worth somewhere around 130 bucks. It's trading for 143, but it's got a lot of upside. It could be worth 400 something dollars if they really take off, but it's got a lot of downside as well. It might only be worth 60 bucks. And you say, that's crazy, those wide ranges. Well, the official CFA research report that they provided, that report had over 130 scenarios, and they ranged from like $20 to $150 for a company. The ranges can be wide, so don't let that bother you. They can be very, very wide. What are you looking for? This firm is pretty close to well valued. My 4% got me really, really up there, but 4% is pretty high for a Walmart. So I should go back and change my numbers up here. So where did I put that? Long-term growth. So I'm bringing them down quite a bit. But, so that's what you're gonna do. Very part, in your paper, you're gonna talk about all the values you came up with, what the central tendency is. A football chart would be wonderful. And then compare that, make sure you compare that to the current price. And then what's the last thing you're gonna do? You gotta make a recommendation. What would y'all recommend? So what are your choices? You can have a strong buy, a buy, a hold, a sell, and guess what else you can do? Strong sell. What do you think I would say on Walmart? I'd probably recommend a hold. I think there's some good possibilities here. It doesn't look expensive. The upside looks interesting. There's a lot of downside, but that's true with anybody in this industry. If I'm going to be buying your retail stock, Walmart looks like it's got some interesting things to do, so I'd put a hold on it. I don't necessarily say you got to go buy more. I wouldn't necessarily say sell what you have, but if you own it, I wouldn't have any problem keeping it right. So that's papers 3 and 4. I'll show you some example 3 and 4 papers, but you got everything you need. What you got? Anybody picked your company yet? If you happy? So if you have any questions about it, you can email me, make sure, or come catch me in the FSC and I can help you get your data. All right, if you came in late, make sure I have you on attendance. I will be here next Tuesday. It's actually a pretty important class because I will show some examples of papers 3 and 4. And we're going to start on derivatives, which is my favorite topic, almost second favorite topic. It is a class that if you're going to do a Zoom as a makeup, that wouldn't be a bad one to do if you're traveling and all that. But I'm still going to have class because I'm not going to shortchange derivatives. It's too important of a topic. So I'll be here. We have gotten much easier about canceling classes in college. I'm in the camp that believes we're doing important stuff here. A lot of professors have left that camp. It was like, let's just go through the motions, but I'm not. This is important stuff, especially derivatives, really powerful stuff. All right, so I want to just real quickly finish up papers 3 and 4, let you get started on them this weekend, get a good draft going, and I'll show you some example papers next week. We need to do relative value analysis. Those that had my 3013, you're going to see that again. So a few of y'all, 5 of y'all will see that again, but it's a good reminder because it really is critically important that you have a good solid foundation of what relative value means. If we can get in portfolio management, we will. That's something I might shortchange a little bit if we need to. So just real quickly, you got everything you need in the paper for 3 and 4. At the very end, you're going to have a price or prices, and I'm recommending you have some scenarios. I talked about the football field chart, which would be a good one to go teach yourself how to do. I know some students won't do that. If I don't show them how to do it, they're not going to do it, but see if you can teach yourself how to do it. Another approach you can have is what we call a data table. Now, Bill Gates will do a data table for you, but I don't like how Bill Gates does it. So I prefer to do it myself, but I don't know how many of y'all done data tables. If y'all tried that, and it's pretty simple. You can follow the directions, but data what if analysis is just right there. The reason I don't like it is that it really limits. I mean, once you build it, you can't delete or you just can't edit it. It's like it gives you an error message, but you can build it yourself. So let's just talk about. Let's try. We're going to build a data table for the dividend discount model. All right. So our dividend 0, let's just go get those numbers again. Dividend 0, our KE, we got our risk-free rate, got a beta, we have a market risk premium. Let's go get those. Our risk-free rate was what, 236. Our beta, I forget what we finally decided, pretty low beta. I think that's the reason why we're getting such high numbers, 0.45. And a market risk premium, I don't remember, but it's in here somewhere. There it is, 544. And then we have long-term growth, and I don't remember what we used there, but I can go find it up here. 3%, pretty low number. All right. So I want to do some ranges, and I do think I'm a big believer that a stock is not, you don't value a stock, you determine the distribution on the stock valuation. because stocks are really hard to value. And some companies like a Google or like a Better Meats, what is it now? Beyond Meats, these kind of firms, they're either worth zero or they're worth 2 trillion, who knows? So you can get some pretty wide ranges. Walmart will get some wide ranges. So what I want to do is I want to do some scenarios on beta and scenarios on growth. All right. So what I'm going to do is I'm going to put my betas up here. And I want to start with my lowest valuation on the top and the highest at the bottom. All right. So that means I need my highest beta up here. So I'm going to go with 0.8. I'm going to come down by 0.05. And I might go down as low as let's do 0.3. Boy, that still seems awfully low to me. And on growth, I'll start at 0. And maybe I'll go up to 5%, right? I mean, 5% long-term growth for Walmart would be pretty amazing for them. Remember that chart I showed you? They haven't grown that fast in a long, long time. They've been growing 3% for the longest time. All right. So let's do the math then. So what is the formula? So we've got dividend 0. That's not going to change. So we can lock that in. Times 1 plus long-term growth. Where is that? Right there. What do I need to lock in? I don't want to lock in everything. The only thing I want to lock in here is what? Just the column. Very good. I'm going to divide that by the risk-free rate. Want to lock that in. Plus the market risk premium. Lock that in. Times beta. And here, what do we lock in? Just the row, right? That should give me a valuation. Really, really low valuation. Now, I forget my assumptions were over here. Let's check real quick and see what we get. Just to make sure this is all right. That times 1 plus long-term growth divided by that plus that times that minus. Oh, I forgot to subtract long-term growth, didn't I? Did I subtract long-term growth? I didn't, did I? So I need to subtract long-term growth, lock in that column again. It didn't matter there because it was 0. Copy that down. So what I'm looking for is that base case. Where's my base case? A beta of 0.45 and growth of 3 right there. Let's try 12. Does that look right? 124.70. 124.70. That looks right. All right. So what can I do? I can just copy this over. There's my values. Now, what values do I know are not valuable? What's the value of Walmart there? It's infinity, right? So we know that's not right. So what can we do? Well, we can say there's a couple of things we can do. We can give it a max. What's the absolute max on them? You just pick a number. I'm going to say 750. So we're going to say if that is greater than 750, and don't give me anything, comma, if all of that, I could use an if or, oh, come on, Bill Gates. If all of that is less than 0, give me nothing. Otherwise, give me all of that. Does that make sense? I don't want it to show me $8,000. I don't want to show any negative numbers. Let's see if it worked. Bill Gates doesn't like that. He never likes what I do. Oh, I need a comma. Well, I did that. Comma. I should have everything. All right. So it's a parentheses problem. So if all of that is greater than that, then give me that. That looks fine. If all of that is less than 0, give me that. Otherwise, give me that. Do y'all see where the arrow is? You type equal 1 plus shows 2. No, I don't. Not trying to type a formula first character is
Just
equal.
trying to throw another like parentheses at the end. That's my always try.
Yeah, but it's black, so it's closing. And then of course, Bill Gates doesn't let you fix it because he doesn't know what he's doing.
If statement.
So let's look at it again. So got if that, if that's the big if, right? So if this, no problems there, are there?
In your first if statement, you have 2 parentheses.
That should be fine, right? That's the numerator. I hate these parentheses issues. That's the numerator, that's fine. I've got 2 parentheses at the end because I've got 1 plus growth there. The bottom is fine. That looks fine. If that's greater than that, and give me nothing otherwise, and now we have a whole new statement. So if all of that, that looks fine. Denominator looks fine. If all of that is less than 0, then give me that. Otherwise, boy, I sure don't see it. All right, so that's when you give up. You do it twice. I have no trouble wasting space on, so what I'm gonna do, I take this whole thing, put it down here, and then I'm gonna say if that is greater than, and I wouldn't do it like this, Josh, you'll be able to do it better. That's greater than 750, give me nothing, comma, if that's less than 0, give me nothing, otherwise, give me that. Should work. All right, y'all see how I cheat sometimes? Sometimes you just have to cheat. All right, so I've got a pretty good looking chart here. The current price is what? Let's go find that real quick. I'll probably get Waste Management's price, but that's okay. Yep, I think I did. Nope, I got it 143.17. Right, so I've got some values here. And I want this to be color coded. What is good for me? If I value Walmart at $300, is that a good thing or a bad thing? Do you like Walmart at $300? No, if you value at $300, you think it's worth $300 and you can buy it for 143. Is that a good thing or a bad thing? That's a good thing, right? So we want this to have conditional formatting. What we want to do is say, if it's greater than this, we want it to be what? Green. You agree with that? What if it's less than that? What do we want to be? What if it be red? All right. So this is something you could definitely put. You could definitely do it much better. You might put growth up here and just center it and give it a title. You might put beta over here and center it and give it a title, and you can turn them sideways, but just give a better looking chart. But this looks good in your paper. Now the question is, what is your kind of base case? And my base case is a little bit off to the side. Usually you want your base case to kind of be in the middle. So you might have something in the middle that you might highlight as your base case. And looking at that, what are you going to say for Walmart? Probably not going to be a buy recommendation, is it? Okay, and you can look overall, it doesn't look good. So there's another approach. That's not quite the football field approach. That's, you know, a data table, but data tables work well as well. Sorry, I couldn't get this. If it's the if function will work, I just don't Bill Gates is way too picky about the parentheses. All right. I'll put this file out on Blackboard if I remember. You don't want to use it. You want to create your own, but just if you want to, if you're not sure about the formulas. But this is essentially what the data table does. The data table, you put the formula right here and you tell it you want to change the beta, you want to change the growth, and it fills in the table automatically. But if you want to go out and delete something, like I did down here and make these, but you can't do that with the data table. It just gives you error messages. So I prefer to build my data tables. I was really excited when I first saw data tables, but it doesn't really save you that much time to do it yourself. And you have a whole lot more power, much more control over it if you build it yourself. So this is essentially what Bill Gates is doing when he does data tables, but you can do it yourself. All right. So that's your paper. I'll give you examples on Tuesday of some good papers, but get your discount rate, get your growth rates, value stocks, and come in with a recommendation. If you don't give me a recommendation, you're going to lose a lot of points. There's a lot of students at the very end tell me what they think these companies worth, and they stop. And I'm like, well, so what? You think it's worth 200 bucks? Should I buy it or not? If you don't end with that, you've kind of written a paper with no purpose. So your final purpose is buy, sell, hold, strong buys. So this might be a sell or a hold. When I did this approach, you can see up here, I was more kind of a hold, just depending on what assumptions you use. All right, so this is a very different approach than maybe some other classes. I prefer this approach. I don't like the multiple choice approach where they give you all those numbers and you stick them into a formula, because that doesn't do anything. It's amazing to me. I know a lot of finance students that are graduating, and I ask them, go do an analysis of a stock and give me a buy or sell recommendation. They don't know where to start. So this walks you through the whole process, right? Now, what confidence you're going to have at the end that you did a good job? Probably pretty low. Right? If this is the first time to do this, it's probably gonna be pretty weak, but you've gone through the process and you get better over time. It makes a lot more sense than sticking numbers into a formula. And so come up with your own assumptions, make your own I don't know, it's your story, right? There's a story aspect to it, your own story for the company and what you think about it. If you're convincing and you can write a good paper, if you're a good writer, it does help your career quite a bit. There's a communication aspect to this business. All right, let's look at relative value. Very, very, very important topic. Dr. Damodaran, I watched his video on this. It's probably the first time I ever found Dr. Damodaran was in relative value. And I've copied some of his stuff in here because it was really, really good. He does a great job on this. But in that video, he says, I never taught relative value before, because in college we say everything's what you did in papers 3 and 4. It's discounted cash flows. That's what you're supposed to be doing. But as he talked to alum 5 years later, he found very few of them were doing discounted cash flow, and they were all doing relative value. Now, he said none were doing discounted cash flow. I had to find that really hard to believe. I do believe 100% are doing relative value. Everybody does relative value. That's just the nature of in finance. But we did discounted cash flows all the time where I worked. So I find it hard to believe that it was 0%. But he was saying, okay, so everybody's doing relative value. A lot of people are not doing discounted cash flow. I better at least teach it so we do it correctly. And so he does a really good job. So what I'll do is I'll fit relative value in to the 3 categories of valuation. I'll give the real estate example because relative value works really well. Real estate. In fact, when you go to HEB, you're really good at relative value. You got 2 loaves of bread. What do? You look at the price, maybe look at how many slices or whatever, but it's relative value. You're not sitting there going, wow, is this loaf of bread worth $1? Let me do a discounted cash flow and figure out what's going to do to my body and health. No, one costs $1, one costs $1.20. Which one do you buy? Well, it kind of depends, right? One might be healthier, or one might taste better. Who knows? But that's what relative value is. You're not trying to figure out what bread is worth. You're just trying to figure out which one you're going to buy based on different prices. But relative value is often done incorrectly. And so Dr. Damodaran does a really good job to say, what does a good relative value analysis look like? And then we'll get into the actual relatives themselves. So there's 3 ways to do valuation. The one is that you're doing on paper 3 and 4, which is fundamental analysis. You're trying to figure out how risky is this company? What discount rate do I use? What's their growth rate? You put that into a formula and you get a valuation. That's fundamental analysis. Technical analysis, which we don't cover at all in this class, and in my secure analysis class, we spend 2 classes on it. They've got 1 paper on technical analysis. It's their easiest paper. But that's the chartists. Those are people looking at price patterns and trying to figure out when to buy. You've probably heard of support levels and resistance levels and moving averages and sentiment and all those kind of things. Technical analysis is not often taught in the college level. UTSA has a technical analysis class. I don't think it's been taught in about 7 years. Dr. Dalquist taught it, and she's not here anymore. She actually has a really, really good book on technical analysis that she wrote with another person. But it's not taught much. My class covers it just real quickly. And then relative value analysis. And almost everybody uses relative value analysis. There's a lot of people who use relative value analysis exclusively. That's all they look at. So you better know it. It's really, really important. So essentially what relative value is, you're taking the value of something, what its current value is. We're going to see for our cases, it's either price or enterprise value. It's one of those 2, but some value of something, and we want to compare it to some fundamental factor to try to figure out if it's worth it. So if you're looking at a loaf of bread, say this one's $1, this one's $1.20, but this one's a little bit larger bread, or it has raisins in it or whatever. Now you can't just say, well, $1.20 buy the cheaper one, because they're different. And so what relative value is trying to do is, okay, this bread has raisins in it, this one doesn't. How do we figure out that extra 20 cents is worth it for that? And we're going to try to compare it, all around everything we can compare to. So your current measures of value are either price or enterprise value. Enterprise value is essentially the market value of the firm plus all of its debt. And then you can subtract out the cash. But it's essentially price is just stockholders, which is really, really important. Price is just stockholders. Enterprise value is stockholders and the bondholders. It's everybody that owns the company. And then the fundamental factors can be almost anything, but the most common are earnings related, revenue related, or book value related. But there are industry specific ones. We might talk about a few of the industry specific ones. The more you get into an industry, the more specific you want to get on that relative value. So, yeah, sorry, I don't know how to get rid of this thing. All right, so let's talk, give a real estate example. So when you use relative value, you're not asking if markets are overpriced. So housing market today, is it overpriced or underpriced?
Overpriced.
Most people think overpriced. Mortgage rates are really low. Relative value, you don't ask that question. You ask, is this house I'm looking at buying, is it overpriced relative to all other houses? So you're looking for mispricings relative to each other. We use the terms I don't like, cheap and rich, because cheap's the good one, rich is the bad one. I would prefer inexpensive and expensive. It makes more sense to me, but I didn't come up with these terms. You remember with spreads, it's narrow and wider and those kind of things. So here it's cheap and rich, whoever invented that. The word cheap has connotations of low quality. All right, so let's do the real estate example. So I'll give you a little bit more information each time, but let's start with, you're gonna buy a house. All you know that its price is $150,000. You don't know anything else about it. Would you buy that house?
No.
Probably not. Let me give you a little more information. You look in the neighborhood this house is in, you can buy for 150. There's houses nearby that are trading for 875 and 675. Would you buy it now? Maybe. What if this is in California? It's on a cliff with mudslides. With that, well, we'll talk about someone being murdered in it. That's one of my examples. So you're intrigued, but there's an obvious question to ask. why is this trading so cheap? That's the same thing to do with stocks, right? Why is this company trading so cheap? Now be really, really careful. Students make this mistake. You make this mistake in an interview, they will not hire you. I will just tell you right now. So Alphabet is a $3,000 stock. Is that an expensive stock? We don't know. Why don't we know? Relative to what, right? I hear students say that, man, Google's really expensive. It's $3,000. Well, if they do a 10-to-1 stock split tomorrow, what will the stock be? It'll be a $300 stock. If they do a 100-to-1 stock split, what will it be? It'll be a $30 stock. So that's meaningless. But I have students say, man, Alphabet's a lot more expensive than Amazon. Oh no, Amazon's a lot more expensive than Google. Wow, that's just amazing, these stocks, what they're doing. So yeah, I'm gonna buy Google because it's only 3,000 and Amazon's 3,700. That's so meaningless. So that's not what we're talking about here. So here the house price is actually the market cap. It's not the actual stock price, right? Because you're not buying one room in the house, you're building a whole house. So here we're saying Amazon is 1.9 trillion, just crazy numbers. Alphabet is 2 trillion. Alphabet is more valuable, but it may be more valuable because it has more rooms in their house than Amazon. That you can do, but you can't just compare the price. The price is completely meaningless because they can shift that at any second just by doing the stock splits. So now you're more intrigued, but in your mind, there's something wrong with this house. Right? If Amazon's trading for 50 billion, if a $50 billion company and Alphabet's, a $2 trillion company, then obviously you think the two firms are doing the exact same thing. Like, okay, what's wrong with this firm? Why are they trading so much cheaper than a comparable firm? Now, if I do it per square foot, this house you can buy for $75 per square foot. Those other two houses are trading for $250 and $225. Are you interested now? Still got the same problem of the mudslide and the cliff and all that, but at least adjusted for the house's size. That's good. And price per square foot is a price relative. Would you buy a house without knowing the price per square foot? That'd be a little unusual. Oh, there's a lot more information we could get. So what if we go out there and get a lot more information? It's interesting. I made up these numbers, these factors on my own. I was listening to, I don't know if a podcast or reading a blog, and they were doing the exact same thing, and they had almost the exact same list as I had. But I had a few extra things. So there are people that do this. I know Zillow is having some problems buying houses on this data and maybe being a little too aggressive, right? They're having some problems. But we already adjusted for the size. That's what the square foot is. Does it have a pool or not? How many bedrooms, the quality of the kitchen, landscaping, those things that people are interested in related to value or quality or value. And then you want some stuff on risk. Does it have foundation issues? Are there neighbor issues? Is it in a floodplain? Is it on the side of a cliff in California about to come down? Or is it in forests that are burning down in California? Is it in a hurricane area? Those kind of things. So it just depends what you think is important. Now, the trick is you got to put stuff in here that everybody thinks important because you're trying to figure out how's the market value in this house, but you also have to make sure you emphasize things that are important to you. So when you do regression like this, it might weight pool at 10%. Pool may have 10% impact, but you don't want a pool. That's just a nuisance to you. So if a house is cheaper because it doesn't have a pool, that could be a positive for you. You're actually getting a discount because you don't have this pool you have to take care of. So you get to decide. Same thing with Microsoft versus Amazon. There may be things the market's valuing that you don't think is important. So if they're charging an extra 10% for Microsoft because it has a really good ESG and you're a really bad person, you don't care about ESG, say, hey, I'm not going to pay an extra 10% just because they're good for the ecology. I'm going to be dead when the world crashes. What do I care? That's up to you to decide. When you do all of that, you can explain housing prices, 91% of the variability in houses pricing by using those factors. That's a pretty good model, right? So when you do that, this house gets a value of 150 per square foot, but you can buy for 75 square foot. So the question is, do you buy it based on this model? If I were using this model, I'd be really happy with the 91%, but I would also, wouldn't you want to know the weights? What does the market say is important? That'd be pretty important. And I might actually go in and change those weights to what's important to me, and then see what I think the house might be worth. But I've got a pretty good model here. And we do this in the investment society. We build these models, try to figure out what is the stock market saying is most important about these companies. And then I go back and say, well, I don't think that one's as important as it should be. I think they need this. But you're tempted now. This house you can get for $75, and it should be trading for $150. Now you're still wondering, did we leave something out? Kind of the Blake's point, right? So let's say we left something out. And let's say now we add two more. Was anyone murdered in the house, and is the house haunted? And that kicks our R squared up to 98%. Now the value is not 150, now it's $80. Now you know something bad has happened in this house. But let's say you don't care if anyone's burned the house. You don't care about it being haunted. What does that mean for this house? You're getting a $150 house for $75. You're really, really happy, unless what? You're gonna have to sell it in 2 years. If you want to live in this house for the next 50 years, you don't care if it's haunted, because you're getting a $150 house for $75. You're really happy. If you need to sell it in 2 years, then you're worried because people buying it from you, that might be important to them, right? The same thing with Microsoft versus Amazon. If you're Warren Buffett and you're buying businesses for the long term, you don't care what the market thinks important, because you're just going to hold, Dairy Queen forever. And you just buy it and you hold on to it. But if you're going to be trading frequently, you better understand what the market thinks important. Remember that word catalyst? So the market thinks this is important. You don't think it's important. You think the market's going to come around to your view. Well, it's going to take them 10 years to come around to your view. You probably don't want to buy the stock, but if they may figure that out in 6 months, it might be a good one to buy. All right. So those are the two things you might look at. And I know people who think they live in haunted houses and they brag about it. It's like, why are you telling people that? They're not going to sell it. So that's relative value analysis. We're not asking if $75 is the right value for the house. We're asking, is it the right value for the house relative to all of its qualities, relative to other prices? So is the house I'm buying, is it reasonably priced given all the differences between it and other houses? And this is the most difficult thing. It's really hard to compare a Microsoft to an Amazon to an Alphabet. Can you really figure out the differences in those? You can certainly look at their margins, their turnover, those type of things. But what's not in all the data is what they're going to do in the future. And that's the toughest part, is to figure out how's this company going to be managed in the future and what they're doing. So it's easy to bring in historical data and do these regressions, but if the market's focused on the future, it's really tough to get a high R squared on some industries. So the key for a good relative value analysis is you must take your relative and adjust it for positive fundamentals, for risk. You want to get as specific to your industry as you can. That's what you need. You can't look at relative value analysis and not have both fundamentals and risk in there. So let's say you see a stock and say, wow, that stock's really cheap and they've got good return on equity. Yeah, I'm gonna buy that stock. But you don't have anything on risk, and you buy the stock and discover they got a truckload of debt. Say, oh, now I see why their ROE is so high. They're levered up in debt. They're very, very risky. That's why they were so cheap. I thought they're cheap because a bunch of intelligent investors just missed this one stock. That's highly unlikely, right? But if you adjust for the risk, then you say, wow, that stock looks cheap if you look at its ROE, but once you adjust for debt, it's really not all that cheap. Maybe I don't want to buy that. So don't forget to put the risk factors in there. So all three must be present. The appropriate price relative, we'll talk about that. So you use PEs, EV to EBITDA, EV to sales, price to book. Which one do you use? Must have fundamental factors and risk factors. So essentially what you're doing is you're trying to run a regression or a forecast. We're trying to take number of bedrooms, kitchen quality, floodplain, take all those factors and try to forecast what the price of the house should be. We're going to do the same thing with Microsoft. Take its return on equity, its turnover, its margins, its debt levels, and try to use all of those to try to forecast their PE ratio. And we know higher fundamentals should give you higher values. A firm that's growing fast, has good returns, they should be more valuable than a firm that's not. Higher risk factors like beta, higher betas should mean lower relative values. If you have two firms and they're identical, but one has a beta 1.4 and one has a beta 0.8, the firm with the 1.4 beta should be cheaper than one with the 0.8 beta. And you just saw that in the formula, right? It gives you a lower discount rate, so it gives you a higher valuation. So that should be consistent. What we're trying to do is figure out a company that has great fundamentals and low risk, but that's cheap. Do you expect that to be? Do you expect stocks just to be out there cheap, lying around? Oh wow, this company's worth $200 and I can buy it for 20. How often is that going to exist in markets? How lazy do you think your competition is out there? They're what, 60 hours a week, 70 hours a week? They got computers. I saw one guy got 11 Bloomberg terminals on his desk. It's like, my word, why do you need 11? It's like he's watching every single market. One of his stocks moves 12 cents. He's like, he's on it. That's what you're competing against. What's the chance those guys are like, oh, there's 5 stocks over there, they're not really watching those. No, every stock people are watching really, really carefully. But that's what you're after. Somehow the market just missed it. We got this great company, great fundamentals, not very risky, and it's cheap. That's what we're hoping to find. Unlikely to find it, but that's what we're hoping for. Now here's a ratio. This is one of those things you should carry around in your wallet. This is really, really, really critical. But we know the value of the stock is the dividend divided by KE minus G. We just did that on paper 4, right? The dividend discount model. We can expand that to say that the price of a stock is earnings per share times payout. And what is that? Earnings per share times payout, what does that equal? They made $4 per share and they're paying out 20%. That's the dividend. The same thing here, right? I just took dividend and I expanded it out. Divided by what is this? Risk-free rate plus beta times market risk premium. Isn't that your KE? And then G. All right, so we expand it out. How do we get from this to a PE ratio? There's price. How do we get from price to earnings? Can we just divide both sides by earnings? Isn't the PE ratio just that? That's a really critical. If you're going to use PE ratios, realize what the PE ratio is measuring. So it's the payout ratio divided by the risk-free rate plus beta times the market risk premium time minus G. There's a tremendous amount of information in that little formula. Let's start off with the risk-free rate, interest rates. What's going to happen to this formula when interest rates rise? If the denominator rises, what's the PE ratio going to do? Go down. So higher interest rates mean lower PE ratios. Is that true? It's absolutely true. In fact, I think I can prove it to you. I always like proving things to you. See if I can find it. I forget when I did this, so here it is. You should do this yourself. You also go down to the Bloomberg machines and try to do this yourself. See if I can find it though. Here it is. All right, so it's a little hard to read, especially with Zoom in the way. But what I did here is I put this is inflation, not interest rates, but there's a relationship between inflation and interest rates. So when inflation is low, what are PE ratios? Low inflation, high PE ratios. When inflation's high, what are PE ratios? So in the late 70s, early 80s, we had PE ratios of like 7 or 8. Today, what is inflation? Well, I don't know if y'all were at the society meeting. Colin, you might remember this one. But inflation's been about 2%. So we should be right here. We're actually way over here, which means right now stock market is the most expensive we've seen in probably ever, never, never. Now, it may not be so expensive if that inflation is transitory, but inflation is not transitory. We're in an extremely expensive stock market. See how it's all by itself? It should be right here, or maybe up in here, but it's way over here. So that inflation, we should have PE ratios of like 14 at the current inflation levels. Instead, we have PE ratios of 25, which means the stock market's like incredibly overvalued. If inflation's really here, then, you know, PE ratios should be 18, 19, and then they're 25. So it's still over expensive. What are all these dots up here? Any guesses on these dots? When was the stock market just ridiculously expensive? Guesses? When?
70s.
Not seven. No, the 70s are kind of down here with high inflation. You know, if the 70s were expensive, you'd see stuff up here.
90s?
You're getting close. So late 90s, right? So 98, 99, the dot-com. This is the dot-com. So if you put us back, let's say inflation is 2%. We're not as bad as dot-com, but we're in a pretty expensive stock market right now. No question. This is a very, very expensive stock market. So, you know, people are saying, well, inflation is transitory, so that we're okay. Well, even if inflation is transitory, it's still expensive. And inflation is not transitory. We're looking at a really, really sharp drop in the stock market. When do we find out if inflation is transitory or not? Who's going to tell us? The Fed's going to start raising rates and really fast. I don't know if y'all ever gone back and look at 1994, what the Fed does. You're probably talking about this in money and banking. Your money and banking talk about 94. Are y'all taking money and banking yet this semester? Y'all talk about 94?
They've covered quite a few areas there.
So what happened in 94? Anybody remember? Greenspan wakes up. It's like, man, you know, I'm worried about inflation. What does he do? He raises rates. How much did he raise rates? In 1 year, any guesses? 50 basis points, 75 basis points, 100 basis points, any guesses? How about 225 basis points? In 1 year, he shot. That's what Feds do when they're worried about inflation. What would happen to our economy if the Fed increased rates from 0 to 2.5% overnight? Boy, it'd be scary. So that's what Feds do. Obviously, stock markets don't like Feds tightening. So, you know, it's kind of a scary thing, but that's what we're looking at here. PE ratios are very sensitive to interest rates. When interest rates are high, PE ratios are low. And really, there's actually a higher correlation with PE ratios and inflation than there is to interest rates, but there is a relationship definitely. And in risk, when there's some major crisis in the world, what happened to PE ratios? Like in 2008, they're going to drop because the markets are dropping. All right. So when interest rates are high, PEs are low. When risk is high, general level of risk is high, PE ratios are low. Beta, these two relate to all stocks, right? Beta relates just to your stocks. So if you're looking at a company with a high beta, they should have a lower PE ratio compared to a firm with a low PE ratio. I mean, low beta. So firms with high betas should be cheaper just because they're riskier. What about growth? Firms that grow faster should have what kind of PE ratio? So we're subtracting growth, we're not adding it. So when you subtract growth, what happens with a high growth rate to PE ratios? Should be much higher, right? So high interest rate, lower PE ratios. High overall market risk, lower PE ratios. Higher company specific risk, lower PE ratios. Higher growth, higher PE ratios, all right? Now I'm leaving out payout. Why am I leaving out payout? Well, finance says if you increase your payout ratio, your growth will go down. I showed you, remember I showed y'all sustainable growth. Sustainable growth is ROE times retention. So if you pay out more, growth goes out. So finance just assumes you can ignore payout because it's directly tied to growth. These two just offset each other. The higher your payout, the lower your growth. The lower your payout, the higher your growth. So we can just ignore payout. But everything you need to know about PE ratios is in there, that ratio. You can also do this analysis with EV to sales and price to book and other things, but you have to add a lot more factors. So we won't get into that. But I would, if I were you as a finance major, I would just know this off the top of your head. Tells you everything you need to know about PE ratios. In fact, it'd be cool in an interview, you know, if they're talking about PE ratios being high, you know, you'd be able to talk what we just did. It's like, man, yeah, with those inflation numbers, PEs look especially high unless they're trending. That would be a really sophisticated thing to say in an interview for an undergraduate student. All right, so I don't know when I pulled these numbers, probably August, but Zoom was trading at 263 times earnings. Ford was at 8 times, Walmart 21, Amazon is 94. So are they cheap or rich? So is Ford cheap or rich? Well, they're definitely cheaper than Zoom. So you can get $1 Ford earning and you only pay $8 for it. So in the next 8 to 9 years, if Ford's earnings just stay about the same, you'll get all your money back on the stock. That's pretty good. All right. If you buy Zoom, you have to pay $263 for $1 of earnings. How long is it going to take to get your money back if they don't grow their earnings? 263 years. You're probably not going to be around in 263 years. I know there's firms that are developing the youth drug, but that's talking about getting you to 150, not the 263. So what is the market really telling you? Well, Zoom's going to grow their earnings so fast that you'll get your money back. And in Walmart looks kind of expensive relative to the Ford, but what can we say about the beta between Ford and Walmart? Who has the higher beta? Ford. So Ford should be cheaper. Walmart may not be expensive. Walmart may just be low risk. And Ford may not be cheap. They just may be high risk. So the beta might explain almost the entire difference between Ford and Walmart. That's certainly possible. I think Tesla's probably explaining Ford as well. So is Ford cheap? Yeah, they are cheap, but they could be slow growth. They're definitely high risk. Could be some combination. Ford might be exactly perfectly priced. They're a cheap stock because they're in slow growth and high risk, and there's no opportunity there. Would y'all be buying Ford right now? Is that a company you want? It's much more excited to talk about Amazon and Zoom, isn't it? If you're in the interview, they say, hey, give me a stock idea. Oh, I really like Ford right now. They're putting what? Ford? With Tesla doing EVs? So you better know what Ford's doing on EVs if you're going to say Ford. That would be an intriguing answer. That's not what they're expecting. They're expecting college students to talk about Zoom and Alphabet and Amazon and Beyond Meats and all those kind of things. So it's interesting, but if you have to have a story behind that and say, okay, Ford is actually doing some pretty interesting things on EVs. So they got the Ford Focus, right? That's an interesting car.
Mustang.
Huh?
They got electric Mustang.
Electric Mustang's still a good draw for them. They still have the pickup trucks. I don't know if they're doing electric I don't think the what is it? F what?
150.
F-150. I don't think F-150 drivers would buy an electric vehicle, would they? Wouldn't that be like, do they have one? Really? When you get shot in the street if you bought one electric? I don't know. In Texas, that seems like it'd be dangerous, but I don't know. But that's what you're after. So you got to figure out if they're rich or cheap by doing what? By looking at their risk, looking at their fundamentals, and then deciding. All of these stocks may be perfectly priced, perfectly approved. Zoom to me is kind of interesting because, boy, they've got some really good competition, and I don't see any economic moat on Zoom that's going to protect them from the other guys. But anyway, so that's the way you're going to think about it. Your numerator is going to be either price or enterprise value. Those are your only two choices. Price is only the stockholders. That's really important to understand. Enterprise value, you're taking the market value of the firm and adding all the debt in. So there's sometimes you use price, like price to earnings. There's sometimes you use enterprise value, like enterprise value to sales. You don't do enterprise value to earnings, that doesn't make sense. We don't do price to sales, that doesn't make sense. We got to figure out that. So our denominators are earnings related, book value, or revenue. And book value is just the net worth of the firm. So what we're trying to figure out on each one of these denominators is, does this solely belong to the stockholders, or is it shared between stock and bondholders? So how do you know if it belongs to the bondholders? There's this term down here, I've heard students say earnings before income tax. Is that right? What is that?
Interest.
Interest and taxes. All right. What's important to the bondholders? Interest. If it's before interest, if you're looking at earnings before interest, that belongs to the stockholders and the bondholders. If it's after interest, you've already paid off the bondholders, whom does that belong to? Only the stockholders. So anything that you're using that is net of interest expense, like earnings per share, book value, those have interest expense subtracted out. You always use price. So price to earnings, price to book value. You would never use enterprise value to book value. That doesn't make any sense. Anything that's comes before interest expense, like EBIT, EBITDA, revenue, anything that's before interest expense, you always use enterprise value. All right. So someone in an interview, someone says, what do you think about price to EBITDA? What would you say? Is that a good ratio? Price to EBITDA? What should you use for EBITDA? Should always be enterprise value. Anytime it's before interest is always enterprise. So EV to EBIT, EV to EBITDA. EV to EBITDA is the most popular one right now. Dr. Dan Madera says it's just because we like to say EBITDA. It does have the advantage that you have fewer negative numbers because you're adding so much back. You can't do a PE ratio if their earnings are negative. So if you add interest, taxes, depreciation, amortization back, you're less likely to get negative numbers. So that's one advantage to it. All right, so that's the key on the exam. That's all I'm asking you is, well, two things. Which ratios make sense? PE makes sense, EV to EBITDA makes sense, EV to EBIT makes sense, price to book makes sense, EV to revenue makes sense. So I would just, if you can't figure out when to match them up, just memorize those. And then when to use price to earnings, when to use price to book, when to use EV to revenue. So that's the second thing on the exam. So, all right, we just talked that. So we have earnings-based ones, price to earnings, EV to EBIT, EV to EBITDA. The PEG ratio is the PE ratio divided by expected growth. That's a really popular one for tech stocks. You have book value related ones, price to book value, or one I think can work really well is price to many years of earnings per share. If you've heard of Robert Schiller and his analysis, he's doing price to 10 years of earnings adjusted for inflation. So if your firm, maybe they just bought a lot of stock back and their book value looks a little distorted, then you can do price of like 10 years worth of earnings, and that can give you a pretty interesting ratio as well. You can't do that with Zoom because they haven't been around that long. You can't do that with Tesla because they've lost so much money. You probably have a negative number the last 10 years. And then you have revenue based. So when do you use earnings based? When do you use book value based? When you do revenue based? So this is the other thing you have to figure out on the exam. What time it is. I still think they need a garage sale on all the clocks in this building because they're all pretty useless. All right, so earnings based, anything where it's like, you remember we talked about growth stocks? Growth stocks like earnings based. So technology, if I'm looking at tech stocks, I'm probably going to use EV to EBITDA. It's going to be the most likely thing, or PEG ratio. PEG ratio is pretty popular. Book value base is a little more complicated. There's three groups in there. Firms that have a lot of property, plant, and equipment, like utilities, heavy manufacturing, maybe like Caterpillar or John Deere, maybe even Intel, because Intel has big fabrication plants. Price to book makes a lot of sense. So look on their balance sheet and look at their property, plant, and equipment. If it's 3% of their assets, price to book doesn't make sense. But if their property, plant, equipment is 40, 50, 60% of their assets, price to book probably makes sense. The second type are really volatile, cyclical commodity-based companies like energy and materials, steel companies. Because their earnings go up and down with the price of whatever they produce, you want to look at price to book so you don't just, energy companies look really cheap when oil prices are high and they look really expensive when oil prices are low, but that's just the cycle of the commodity. So if I'm looking at an Exxon, looking at a steel company, I would be using price to book. Price to book is very popular for emerging market countries, for their stocks, mainly because emerging countries tend to be very heavy commodity-based businesses. Maybe not China, but a lot of countries like South America are very, very commodity-based. So price to book just makes a whole lot more sense for them. And then the last one, which is my industry, is finance. Those companies that are really focused on return on invested capital, like banks, insurance companies, always use price to book. Banks always do price to book. I think it's interesting what's going on in banking right now. If you look at Citibank. So banks, my whole career until 2008, banks traded a 2-to-1 price to book. So banks were twice as much as what the accountant said. And then suddenly what do you think 2008 did to that ratio? Probably dropped it, right? So you look at Citibank's price to book right now, it's 0.76. Now you remember your accounting's supposed to be conservative. Why is Citibank trading cheaper than its GAAP net worth? That is really, really, really bizarre. If I'd seen this in 2006, 2007, I would have been putting my entire portfolio into Citibank. It's like, what in the world's going on? Even JP Morgan, and they're finally back up above 1, I think. Even JP Morgan, not even back to 2 yet. So they're looking better, but they're still not back to 2. So that 191, you say, wow, they look really expensive versus Citi, but they don't look that expensive versus where we're used to them being. And you can even get even crazier. If you look at a Genworth Financial, what is their price to book? 13 cents. The accountants say it's worth $1, and you can buy it for 13 cents. And the accountants are conservative. Why wouldn't you put all your money in Genworth? Anybody know why you would? What does Genworth sell? Probably the worst insurance product there is, long-term care. And they really messed up on it. And so they had right, Garrett, we talked about in my class. I think we talked about Genworth in my class, didn't we? So you're seeing this twice. Yeah, the worst product possible. And I showed his class an article where they're jacking up prices. And when you jack up the price of insurance, what customers stick with you? The ones most likely to file a claim. Right? So it's just a horrible business, but that's cheap. That's really cheap. You're not going to find that with Amazon. Amazon's price to book is 14. What was JP Morgan's? Less than 2. Why would you pay $15 for $1 net worth for Amazon, but you only pay $1.96 for JP Morgan? They're very different businesses. If USAA were to sell its bank, I can never remember the COF. I can remember their ticker. Most likely they would look at the price of book for Cap 1. It's 108, and they would probably sell their bank. They'll take their GAAP net worth, multiply by 1.1, and that's probably what they try to get for it, because they're most like Capital One versus anybody else. They might be a little bit like Cullen/Frost. Cullen/Frost is a very immutable bank because of their deposit base. They have a very high deposit to loan ratio, makes them a really great takeover candidate. Not quite as expensive as JP Morgan until you look at the current. But I don't think USA's bank looks like Cullen/Frost at all. They probably have a fairly low deposit to loan ratio because of other securitization. But anyway. All right, so that one's a little more complicated. So if I give you a utility or manufacturing firm, you just automatically think price to book. And then retail is really easy. Retail is always EV the revenues. You're looking at Walmart or Costco or Nordstrom's, EV the revenue is always in there. But then you got to make sure when you're running your regression that you have gross margin in there. Because Walmart looks really cheap on EV the sales basis. And why is that? Why does Walmart look so cheap on EV the sales? Well, because their sales are massive. But their sales are massive because their margins are so thin. You know, you're getting them cheap because $1 revenue is only giving you like 20 cents of earnings. So very different. I don't know if I don't think it's going to work now because these firms are so messed up. But we'll try it anyway. So their EV, you notice they have price to sales on here. So Yahoo Finance has one error. You don't use price to sales, but EV, the revenue, Walmart is 312. But these are quarterly data. I wish, boy, we can't do the annual. The EV, the sales is when we have problems. So 312, let's compare it to Nordstrom's, and I can never remember Nordstrom's ticker. JWN. Yes. Walmart actually looks expensive versus Nordstrom, so there's some strange things going on right now that don't really work. But you got to make sure, and I don't know if Tiffany's is even trading anymore. Did they go private? So I can't even show you Tiffany's. I can't think of a really good. Well, we can do TSLA. TSLA's, there's their enterprise value of revenue, 56. That is insanity. That is absolutely crazy. $56, not $56 for $1 of earnings, $56 for $1 of revenue. I mean, that is crazy, isn't it? I might pay $56 for $1 of earnings. It's going to take me 56 years to get my money back unless they grow the earnings. But I got to pay $56 for $1 revenue. Then they got all their cost of goods sold. Auto manufacturers, their net margins are like 20 cents. So what's their PE ratio? Yeah, that's $400 for $1 of earnings. I mean, I can't make heads or tails of Tesla. They're going to take over the world. The problem is all the other EV companies are priced to take over the world too. So I don't know how 5 companies can all take over the world. So someone's got to go. But this is the key, all right? So if I give you MetLife Insurance Company, what's the most obvious ratio that would jump into your mind? MetLife Insurance Company, you want to look at their what? Price to book ratio, exactly. Caterpillar. Price to book. NVIDIA. EV to EBITDA. Kohl's. Having your reps. See, it's not that difficult, right? Seems pretty straightforward. What we do in our models, investment society, we actually bring all of these in. And we do retail. We know the model is going to put 100% to EV to sales, but we're just curious. What we discovered is recently with tech stocks, you expected to put 100% EV to EBITDA, but it might actually put 50% to EV to revenue. So I like that the model tell me, you know, what best defines these companies. But yeah, it's interesting. But for banks, it's always going to be priced. It's just that's the way we think about them. It's just the most normal way to do the analysis. So what can you do? Well, obviously, it's good for screening stocks. If you want to join the investment society next semester, we have the sector wars, which looks really, really good on your resume. So what they did this semester was build the models. And they came to a buy list. What they're going to do next semester is take that buy list and get it down to their final presentation. And the students that are doing that, so Olivia, you're in consumer staples, right?
Yeah.
And they need someone to take that over. Maybe we can talk to Olivia into doing that, but take that over. So they got a buy list. They were talking about some of your stocks last time, right? You know, I forget some of the ones y'all saw on your list, but what about this one? What about this one? So next semester, each person on our team will take 1 or 2 stocks and do an analysis of it and get to present it in front of some portfolio managers at the end of the semester. We'll record it so they got something they can show on YouTube with their presentation skills. It's a really good opportunity. But this semester, it was a screening model. So we try to screen down 500 companies down to like 10 to 15 we think are interesting, and then we're going to do detailed analysis there. Value in a non-public traded company. So USAA sold off its investment firm. They probably use EV, the assets under management, to try to figure out how much to sell that to another entity. If they sold their bank, they would probably look at price to book to do that. It can give you benchmarks for a company, private or public. So you're trying to say, what should our gross margin be? And you look at your valuation and adjust it. And HEB could do this. HEB could see what should our gross margin be, given what Kroger's is doing and Safeway, these other entities. And then it tells you what is the stock market focused on right now. You may disagree. You might say they should be focused on this, they're focused on that. I'm going to go with what I believe, buy stocks, and when the market comes around to my side of it. You could use this for bonds. I've not seen many people do this, but you could take CDS spreads, OAS spreads, and bring in, all kinds of factors and try to see, essentially what the rating agencies are doing. Why does this bond have a 10 basis point spread and this bond has a 100 basis point spread? And you say, oh man, they got a lot of debt. They have really, really weak earnings, those kind of things. So those kind of things that you do. There's two ways to do this in Investment Society. There's the regression approach and the ranking model approach. I started with the regression approach because that's what Damodaran does in his class. When I was a security analyst, we couldn't do either one of these because we didn't have the data. Everything was by hand, but now you can. You can teach yourself this. You don't have to join the Investment Society. You go to my YouTube channel. And I would recommend you do the aerospace one. Aerospace one is a ranking model and it's only about 20-30 minutes worth of videos and you can teach yourself the entire process. Boy, I'd strongly recommend you do that before you start interviewing with jobs so you can talk intelligently about how to actually do that. But it's a ranking model. Essentially what we're doing is we take all the fundamentals, all the risk, and then we have each firm ranked on each one of those and we do a weighted ranking. And we're trying to see if our weighted ranking matches the valuation weighted ranking. So the firm that we thought was the best, are they the most expensive? Is the firm we thought was the worst, are they the cheapest? And we try to match those two up and looking for opportunities. So maybe the firm we think is third best is like the 70th most expensive. It's like, wow, that's a good opportunity. Maybe the third firm we think is the 100th best, it's the second most expensive. It's like, okay, we're avoiding that stock. And that's the kind of thing that we do. I'm not going to give you the examples just because of time, but watch my videos, get yourself, being able to do a ranking model, I think is really, really important. When you actually get into the business, they'll show you their approach, but it's not going to be radically different from what we're doing here. It's just data hungry. Give me all the data I can. Let's try to figure out how do we size up these companies versus each other? What's important? All right. When we do the practice exam, I'll give you some examples from prior exams so you can get some practice. That exam question to me is like the easiest on the exam, and it's usually the lowest score on the exams. So it doesn't make sense to me. When y'all were getting it right, when I asked you before, price to book, EV to EBITDA, so y'all seem to be understanding it. It might be an issue of time. You're not going to look at this again until the exam, and it's just going to all exit your memory. And you're going to like, what did he say? You use EV to revenue for banks. Is that what he said? And then, so you shouldn't memorize this for the exam. This is something you should know for the rest of your life as a finance major, all right? This is pretty basic kind of stuff that you just need to know if you're going to be doing stocks. All right. Any questions on relative value? So you get into an interview and a common question is, give me an idea. So Olivia is going to have that because of her team. She gets interviewed next semester. She can have a stock she's talking about. She'll be going there and talk with passion about a stock that she picked. You need to set up an answer for that question. The best way to do it is find some company no one's ever heard of and do an analysis of that and come in with it. And they're like, hey, that's intriguing. So coming in with Tesla or those types, everybody's thinking about those stocks. Coming with some company that's small, no one's ever heard of, that's a little more interesting. So part of this, and this is also important for your interview question, is a portfolio. You want to start your own portfolio. So a student called me the other day. He said, Professor, look at my portfolio and tell me what you think. It's like, okay, you got 50 stocks there. What am I supposed to do with that? Why did you buy this one? Why did you buy this? Well, I kind of liked it. So why did you like it? So I told him, you got to step back and tell me your strategy, your philosophy, your process. You can't just give me 50 stocks and ask me what do you think. That's impossible. So you're going to start a portfolio. If you have $150,000, you can start a pretty good portfolio. Less than that, it gets a little bit tricky. You know, we just saw Amazon and Google trading for $3,000. If you buy one share of each of them, you're already, you know, if you have $100,000, you already have 6% of your portfolio in 2 stocks, right? Because they're so high in price. So 150, but you have a $50,000 portfolio. You can do some stuff with that. Less than 100,000 though, you might be better off doing exchange traded funds. A bond portfolio, I know a lot of people who buy bonds, and boy, they're getting ripped off royally, especially municipal bonds. I know people whose net worth might be 500,000, $1 million, and they're buying municipal bonds, and they are getting taken to the cleaner. And I saw this at USAA. I remember USAA, the bond portfolio managers, they got so mad. They would sell a bond at 92 because that's what it was worth. And they would see that broker turn around and sell it for 100. So whoever bought that bond just had an 8% loss off the top. And they were like, I can't believe these people are buying these bonds for 100, and they could just buy a mutual fund and get it for 92. But yeah, people are getting ripped off on municipal bonds. So you just don't want to. You know, at USA, they traded in $100 million, $500 million blocks. You just got to do it. It's a very illiquid market. It's a market where you've got to find the inventory, and you better make sure you know what that bond's worth before you buy it, because the person with the inventory, they may jack that price up. So for bond investors, most of them are better off just buying a mutual fund. But let's talk about a stock. You want to start a stock portfolio. What do you got to do? This is the question I always ask in interviews. I don't know if you'll get this question, but I ask students, tell me what is a good company and tell me what is a good stock. Is it possible if a good company that's a bad stock? What would that be? Great earnings, great growth, but the stock's way too expensive. Is it possible to have a bad company that's a good stock? Everything's bad about it, but the stock is so ridiculously cheap. Say, why not? Let's just go buy it. What would GameStop be? I think that's a bad company and a bad stock. That's my opinion. All right. What would Tesla be? Great company. I think a bad stock, but who knows? What would Amazon be? Good company, pretty expensive stock, right? So it can be all combination. But what is a good company? Well, good company is, you got to define it. Good company has good turnover. They've got good margins that are rising. They're in good industry that has growing consumer demand. There's opportunities overseas. You know, you're talking about growth. You're talking about margins, return on equity, those kind of things. Good management, high quality management. What's a good stock? Well, it's cheap versus the quality of the firm. All right. I ask that question all the time. When I ask this question, undergraduates, I think I've gotten one decent answer and about 105 horrible answers, including my own students. I'm like talking to some of my own students and interviewing them, like we talked about this in class. I'm like, yeah, I don't know, Professor. We talked like just last week, we were talking about this in class. Guess what happens when I ask a seasoned security analyst that question? They turn around to their portfolio or their bags, and they pull out a big stack of paper, and they cannot wait to answer that question. Here's how I define a good company, so I find a good stock, and they can't wait to answer that question. And boy, they give really good answers. All right, so if you're gonna, I'll give you high level. If you're gonna build a portfolio, you need 4 things. You need a philosophy. Philosophy means I think stocks with these characteristics are going to outperform the market. And the reason why you believe that, you need a process. So you believe these stocks are the ones you want. How are you going to find them? You need a process. That's what we do in the investment society. We're trying to find those companies that meet our criteria. The third thing, you need construction, portfolio construction. So you've got 20 stocks you really like. What are you going to do? You're going to put 1/20th in each stock. You're going to weight them based on some model. And then the last thing you need is risk management. Risk management is your sell discipline and your rebalancing discipline. I didn't put rebalancing in there. So that student that came to me and said, what do you think about my portfolio? I was like, well, what's your philosophy? What was your process? What's your risk management? Those are the 4 things you need. I would definitely have this template ready for interview questions. I'll give you a few examples. We don't have much time. My security analysis class, I give them a lot of examples of this. If you want an example, just type investment pitch book and go look at some of the pitch books out there and see what other people have done. But I'll give you a few examples. But we're going to heavily get into derivatives next class because we got to get into those. All right, that's it for me. I'll see y'all on Tuesday.